Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So we're now in 2020. It's a new year, but nothing has fundamentally changed. We're still incredibly euphoric. We had the Santa rally in December. It finally arrived after the good news surrounding the UK election and, of course, the trade truce. That's what the market wanted. So we saw emerging markets rally as much as 4%, almost 5%. We saw Asian equities rally 4%. We saw the FTSE 100 rally 2%. And we even saw the Nikkei 225, which is the Japanese stock market, rally 0.6%. And US stock markets 0.4%. Now you may think some of those seem a bit low, but they take into account the fluctuations in the value of the pound, because the pound did fluctuate a lot in December, partly because after the UK general election, we had the pound rally immediately very strongly, and then that pulled back after some of the euphoria about the result actually waned and people started to assess what it really meant for Brexit. So we had the pound rally to $1.35 immediately, and it then pulled back towards $1.30. So as we make this video, it roughly sits at $1.31. Now, a lot of headlines will be made about 2019 being a fantastic year for equity markets, and it was. We saw double-digit returns on a lot of equity markets. But if you put it into context of a 2-year time frame, then the picture isn't as bullish. What actually happened in 2018, if you remember at the beginning, we had a sell-off, then a rally, and then a big sell-off at the end of 2018. Then 2019, the markets pretty much went straight upwards once the US Federal Reserve became very accommodative with their monetary policy. Now, across a 2-year time frame, the US market was up 20%. Now, that sounds a hell of a lot, and it is. But you have to realise that between 10 and 15% of that came after October 2019, once the Fed had announced that not QE4. Now that lit a rocket under US equities, and that's why if you look at world equities, they're up 11%, but that isn't widely reflected everywhere else. Across the 2 years, the Japanese equity market is up 4%, the emerging markets are up 0.5%, the FTSE 100 is in fact down 0.6%, and the Asian equities are down about 2%. That's from 2018 across 2019, and that's taken into account that Santa rally that we had at the end of 2019 and that euphoria after the not QE4. Unsurprisingly, the greed and fear index that I mention every now and then is up at levels, well, it's at 97. That's 97 out of 100, which means that greed is driving the market. And in fact, I don't think the greed and fear index has been as high as this ever before, which can be a bit of a contrarian indicator. Does it mean that we could have a sell-off because the market is becoming very greedy? As Warren Buffett often has said, you need to be fearful when everyone else is greedy and greedy when everybody else is fearful. But of course, this week we had some geopolitical issues. So we had a new year and new highs, the euphoria continued, but with America assassinating a top military commander in Iran, that has sparked concerns of a potential war between the US and Iran. So what we're seeing now is a lot of news headlines and the market reacting to each of those. And so we've seen in the last week some defensives do quite well. And we've seen the price of oil spike. In the aftermath of the initial attacks, the price of oil rallied 6%. And we've seen gold, which is a haven asset. So people often rush to gold when they panic. That is at a 7-year high. So where will this end up? Will the market have a significant pullback? In the past, similar actions have seen the market pull back up to 10 to 15%, but that doesn't mean it will happen this time around. We've got to wait and see what happens, how each side acts and retaliates. But one thing I want to leave you with and to think about is that the rally in commodities is actually pushing up something else. It's actually causing inflation to start to pick up. And there's a story that's in the background that no one's talking about, that the inflation is potentially starting to rise. We're often seeing headlines about inflation being very low, but there are signs it could be starting to pick up, and that's not unusual in this stage of the economic cycle. And if that happens, then the Federal Reserve and other central banks could be put in a difficult position, because if interest rates are low and inflation starts to pick up, they may be forced to have to try and raise interest rates. But it also means that those assets that have largely been unloved, that do well in inflationary environments, will start to perform well. And also bonds may start to underperform. So it's something to keep an eye on. The other thing that's fueling that is the US dollar, something I've been talking about for quite a while that isn't getting lots of headlines. The US dollar has started to weaken, and it happened around about October, November time we started to see it, and that pattern has continued into 2020. If the dollar continues to fall, that will actually push up inflation in America. And there's another argument that the dollar falling could be a sign that it's actually front-running the US Federal Reserve, and in fact, that the Federal Reserve will be forced to make more interest rate cuts because the economic outlook is actually weaker than people think. The underlying economy is struggling more, not just in the US, but also globally. So this idea that I mentioned in the last video, where markets have largely dismissed any idea of a potential recession or a weakening in the global economy, that actually may be proven to be misled and actually false. That's something we've got to keep an eye on in the next quarter. Obviously, we've got to keep an eye on what's going on with Brexit and the trade war. Those have largely been put to one side for now, with the news obviously coming out of Iran. But in the coming weeks and days, don't be surprised if we hear more about the US-China trade war, because don't forget, they're supposed to be signing that phase 1 trade deal in the coming weeks or so, and there are noises to say that that might not actually happen. And if that's the case, the markets might not react very well. But at the moment, the market is buying every dip. Investors are buying the dips and actually trying to push through the noise around Iran. And actually, if you looked at equity markets, you think that largely in America particularly, they're not overly concerned. So that is it for Damien's Midweek Markets this week. As ever, you can contact me via email, damien@moneytothemasses.com, Twitter, moneytothemasses with the number 2. And of course, you can also contact me on Instagram and Facebook. Don't forget to join our Facebook community. And of course, don't forget to subscribe to our YouTube channel.